Welcome back, everybody. Stephen Morris here with Advisory, bringing you the hottest tips on real estate, taxes, and real estate taxes. So let's dive into it with another quick topic about real estate aggregation and how does this affect you as a real estate professional and also just as a straight up passive investor. Making this election could greatly change the outcome of your taxes in a favorable way or very much possibly an unfavorable way. So let's talk about what this all means. So as we talked about in other videos, there's this concept of passive income and there's this concept of an activity. And an activity is not exactly defined in the code, but it's some sort of thing that you're doing as it relates to making money. It's like an economic concept. It's an action that you're doing to generate income. Now, the ability for you to group activities in certain ways or not group them can determine your tax outcome. In the real estate world, typically speaking, what we see are people who automatically elect something called an election to group all real estate activities as one. This generally seems like the best idea for most people, except that I want to point out some flaws in doing that depending on your tax situation. For our folks that are real estate professionals, as we know from other videos, for you to be a real estate professional, you must have at least 750 hours in real estate trades or businesses, and those hours have to represent at least half of all the stuff that you do relating to all trades and businesses, whether it's tech or whether it's in restaurant or any of the things that are not related to real estate. So your 750 or more has to be more than half of all those activities. Once you have that, then real estate losses are available for you to take deductions for, and you can take those as ordinary losses. And they would also, if you don't have enough income to eat it up, which is a great outcome, then you'll have a net operating loss, which you can carry forward in the future. Generally, it's a good thing. Now, it's important for you if you have multiple properties. Let's say you're the owner of, you have a 4-unit in one part of town, you have a duplex over here, you have a triplex here, and you have a bunch of scattered properties, the sum of which might equate to 60 or 70 units in the city. The code under Code Section 469 requires you, for you to be able to actively participate, you have to have at least 500 hours in an activity, or you have to be substantially all the participation, or 100 to 500 hours in more than anybody else. However, it's pretty hard to have 500 hours in one particular 4-unit, another 1 and 2 units, another 1 and 3 units. But if you were to aggregate all of these activities into one, then you have an opportunity to generate the amount of hours that you need in order to have this type of outcome for you. So if you don't do the grouping, then the IRS is going to look at every single property that you have as, well, you don't have the hours here, that you're passive, you're passive, you're passive, you're passive, you're passive. And none of the losses that you generate from those properties would be deductible against your other income that you generate. So in this case, what we would love to do is make a election under Code Treasury Regulation 1.469, which allows us to group all these activities into one and treat all real estate interests as one for passive activity purposes. However, let's talk about the other side of things. What if you're just a passive investor? You own a few properties here, a few properties there, maybe you have 6, 7, 8 units under your control, but you work a W-2 job, maybe you're a tech executive or you're a doctor or something like that, and you just don't have the hours to qualify to be a real estate professional. Well, if you decide to just group everything, because that's what you hear as the best practice, ultimately at some point when you decide to sell the properties, you're going to be in bad shape. Because you chose to group all the properties as one activity, if you dispose of some of that activity, and there were losses associated with those, passive losses, those losses are not going to be unlocked. You have to dispose of the entire activity for you to be able to unlock all the losses. So what that means is, let's say you had a duplex here, and you had a single family home over here, and you had 3 units over here. Great, you decide to sell the single family and it has $100,000 of passive losses. And you remember from our presentations that the $100,000 of losses, once you dispose of an activity that's passive, can be deductible against active income after you've eaten up all the other passive income. Well, unfortunately, because you made the election to treat all the properties as one activity, those losses are not going to be deductible to you. In fact, they'll stay suspended until you dispose of the rest of your real estate portfolio. That's extremely problematic, and it's something you're going to want to pay attention to on your tax return. You don't want your tax preparer automatically electing for all of your real estate interests to be grouped as one unless you fall under the real estate professional category. So you got to be very careful about that and make sure that you scrutinize your return. Usually it's at the end of the schedules, there's going to be a statement, or it's going to say elections, and the elections say I elect to treat all the real estate activities as grouped under Treasury Regulation 1.469. If you see that and you're passive, you may want to request that that election is not taken. And also, just to keep in mind, once you make it, you can't unelect it. So that's going to be a huge problem for you if you're trying to partially dispose of some of your real estate. So in short, I just wanted to give you a quick tip here on what the election means in terms of aggregating versus not. Generally speaking, if we're a real estate professional, we want to aggregate all of our real estate activities. And if you are a passive investor that is unable to meet the rules or qualifications to be a real estate professional under Code Section 469C7, then I highly recommend that you choose to treat those interests separately so that when you decide to ultimately dispose of one and unlock those losses, you're able to do so without throwing the whole thing into jeopardy. Thank you so much for watching. If you have any questions at all or you'd like to learn more, then feel free to contact us right here, and we'll be more than happy to assist you with any of your tax planning needs. Thank you so much for watching again. So make sure to like and subscribe to our channel for all the content related to real estate investment and tax saving strategies.